the identity decision. If I had only $100 to invest today, here's what I would do. Not guesses, not hype. Data shows that over the last 20 years, broad market ETFs like SPY returned approximately 9.8% annually. I would focus on low-cost, diversified ETFs, not one hot stock or coin, because small money is not about profit, it's about building a habit. Many beginners panic over $100. Will it grow fast, or they ask? Data shows that short-term trades fail 90% of the time. Instead, I would ignore daily noise and automate a monthly investment. $100 isn't capital, it's a practice. Let's look at numbers. $100 invested monthly in a total market ETF for 10 years at approximately 9% annual return grows to approximately $16,000. That's the magic of compounding. Small money, consistent habit, years of time. Mistakes are emotional. Selling when market drops, chasing trends. Studies show emotional decisions reduce long-term returns. So I would decide now, invest calmly, ignore hype, automate, and let time do its work. The first $100 is not about making money. It's about building discipline, about seeing results in 10 years, not tomorrow, about becoming the kind of investor who sticks to a plan. That's real power, and it starts now. Investment step by step. Step 1. Choose a low-cost, broad market ETF. SPY or VTI are good examples. SPY tracks S&P 500 with an average annual return of approximately 9.8% over the last 20 years. With $100, buy fractional shares or set up an automated monthly purchase. Don't pick single stocks. Data shows 80% of individual stock picks underperform the market. Focus on diversification. Step 2. Automate your investment. Set up a recurring purchase every month. $100 might seem small, but consistency is powerful. Over 10 years, $100 per month in VTI at 9% annual return grows to approximately $16,000. Automation removes emotional decisions. Beginners often sell in panic. Automation prevents that. Step 3. Track your performance quarterly. Use free tools like Yahoo Finance or Morningstar Portfolio Tracker. Note returns, dividends, and growth. Don't obsess daily. Long-term investing is about trends, not daily swings. By tracking, you learn which sectors perform best and adjust if needed. Step 4. Reinvest dividends. SPY pays approximately 1.3% dividend yield. Reinvesting dividends accelerates compounding. Even small $1 to $2 dividends grow significantly over 10 years. This is why patience beats chasing hot tips. Small amounts, repeated consistently, outperform risky guesses. Step 5. Review once per year. Adjust only if your goals or risk tolerance change. Don't react to news. Data shows investors who check too often underperform. The goal is habit and discipline, not daily profit. Your $100 today is practice for $1,000, then $10,000. Long-term consistency beats short-term excitement. Investor psychology. Psychology is the hidden factor in investing. Studies show 80% of individual investors underperform the market because of emotional decisions. Fear and greed dominate. Fear makes people sell during drops. Greed makes people chase fads. The first $100 is perfect to train discipline. Learning to stay calm now builds a mindset that will protect $1,000 and $10,000 later. Emotional reactions destroy returns. Selling low and buying high is the opposite of strategy. Data from Vanguard shows discipline, patient investors outperform impulsive traders by 2 to 3% annually over decades. The first $100 is training. Learn to wait, resist hype, and stick to a plan. Biases are everywhere. Loss aversion makes small dips feel catastrophic. Recency bias makes yesterday's drop seem like the end. Anchoring makes people fixate on purchase price. Awareness is key. The first $100 teaches you to recognize these biases in yourself. Small stakes, safe mistakes, powerful lessons. Group discussions improve perspective. Meet 2 to 3 friends in a cafe or online. Share your plan. Challenge your impulses. Studies show social accountability reduces rash decisions. Your $100 becomes a learning tool, not a gamble. Visualization helps. Imagine your $100 turning into $16,000 in 10 years. Imagine staying calm during market drops. Your brain builds neural patterns. Patience becomes habit. The first $100 is training your mind more than your wallet. That mindset is what compounds wealth, not luck. Sit for 10 years. Let's calculate. $100 invested monthly in a total market ETF like VTI at 9% annual return grows to approximately $16,000 in 10 years. Even small amounts consistently applied create enormous growth. The secret is time and compounding, not luck or short-term trading. For example, if you had invested $100 monthly in SPY instead, the result is similar, around $15,800 after 10 years. Data confirms that broad market ETFs outperform most individual stock picks. The math is simple. Discipline beats intuition. Reinvesting dividends accelerates growth. SPY's approximately 1.3% yield may seem small, but over 10 years, dividends contribute several $1,000s. Small, steady, repeated actions build wealth far better than chasing hype or hot stocks. Consider risk. Total market ETFs are diversified across 500-plus companies. You might see drops of 20 to 30% in a year. Normal market volatility. Studies show that those who panic sell lose long-term gains. The first $100 teaches you to hold during drops. Over 10 years, the math favors patience. $100 monthly becomes $16,000. $500 monthly becomes approximately $80,000. The lesson: scale your discipline, not your excitement. Early, small investments train behavior, which compounds more than capital. Remember, the goal is habit. The first $100 is not just money, it's practice. Buy, track, reinvest, repeat. Let time and compounding do the work. By the end of 10 years, your mindset and wealth grow together. Beginner mistakes. Mistake number 1, chasing hot stocks or crypto hype. Data shows that 80% of retail investors fail to outperform the market due to chasing trends. The first $100 teaches patience. Don't buy based on hype, buy based on a plan. Mistake number 2, selling during drops. Market drops of 10 to 20% are normal. Investors who panic sell often lock losses and miss recoveries. Studies show that staying invested outperforms trying to time the market. Mistake number 3, over-trading. Beginners trade too often, thinking more actions equals more profit. Reality: fees, taxes, and emotional mistakes reduce returns. Data shows active traders earn less than passive investors. The first $100 is perfect to practice restraint. Mistake number 4, ignoring diversification. Putting all $100 into one stock is risky. Broad market ETFs reduce risk and improve long-term returns. Example: S&P 500 returns approximately 9.8% annualized. Individual stock returns are unpredictable. Mistake number 5, neglecting habit building. Money alone doesn't make wealth. Discipline, consistency, and patience are key. $100 is a safe environment to develop these traits. These habits compound more than capital over decades. Mistake number 6, letting emotions control decisions. Fear, greed, regret, and excitement drive bad choices. First $100 is training. When you learn emotional control now, it protects future larger investments. Habit building. Let's review the steps for your first $100. Number 1, choose a low-cost, broad market ETF. Number 2, automate monthly purchases. Number 3, track performance quarterly. Number 4, reinvest dividends. Number 5, review annually. Number 6, stay disciplined during drops. These steps are the foundation of wealth building. Habit is more important than capital. $100 now teaches discipline. $500 later benefits from this trained behavior. Studies show that habit formation is crucial in long-term investing success. Keep it simple. Avoid noise. Ignore daily market chatter. Data proves that passive, consistent investing outperforms active speculation. The first $100 is practice, and practice builds skill. Peer accountability helps. Discuss your plan with 2 to 3 friends or online group. Research shows that social accountability reduces impulsive trading. Your $100 becomes a learning tool. Habits form, mistakes are small. Visualize the long-term growth. Imagine $100 growing to $16,000, $500 to $80,000. Mental rehearsal builds patience and confidence. This is why first small investments matter. They train the brain more than the wallet. After 10 years, your mindset and wealth compound together. First $100 is a training ground. Discipline, habit, patience, these are your true assets. Small, consistent steps lead to extraordinary results over time. Conclusion and call to action. Congratulations, you now know how to invest your first $100. Choose a broad market ETF, automate purchases, track quarterly, reinvest dividends, and stay disciplined. This simple plan works for beginners and experienced investors alike. Remember, small, consistent actions create massive results over time. Start now. Don't wait for perfect timing. Every month you delay is lost potential growth. Even $50 or $100 starts your habit and mindset for long-term wealth. Time in the market beats timing the market. Track your progress and celebrate small wins. Each step reinforces your habit. The first $100 is not just money, it's education. Your portfolio, knowledge, and confidence grow together. Share your journey, discuss with friends, join communities, learn from others. Social accountability strengthens your habits and reduces mistakes. Start small, learn, and scale. Remember, investing is a marathon, not a sprint. $100 today, $1,000 tomorrow. Patience, discipline, and habit are your true assets. Consistent action beats luck every time. Now it's your turn. Take your first $100, follow the steps, and start building wealth. Subscribe for more lessons, examples, and strategies to grow your money and mindset. The journey starts today.